Welcome to Catalyst. I'm Seana Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down the market action as stocks fluctuate with volatility on the rise. We'll have full coverage ahead.
Plus, we'll bring you the latest on the tariffs as Commerce Secretary Howard Lutnick says that a Mexico and Canada deal could come as soon as today.
And we'll hone in on the tech sector and look at how tariffs could impact CapEx plans for those big tech stocks.
Half hour into the U.S. trading day, and here are where things stand. Taking a look at the major averages, not too far from the flat line. We are right around the highs of the session, I believe. You have the Dow up just about 0.6%. The S&P now up about 0.3%, and the Nasdaq also moving to the upside. Maybe some relief that we are seeing creep into the markets following the latest commentary that we did get out from Commerce Secretary Howard Lutnick. Now that investors have had some time to digest what exactly that could mean here in the coming hours. Again, Secretary Lutnick saying that we could see some sort of scaling back or reduction of some of the tariffs that have been announced on Mexico and Canada as soon as today. So again, that's something that's obviously going to be a market moving event and something we are keeping a close eye on. Flipping over to the bond market there, we saw a bit of movement on the back of a weaker than expected ADP print. As it stands right now, you do have the 10-year yield off just 1 basis point, right around that 4.2 level. And flipping over to Bitcoin, more of risk on action that we are still seeing creeping into the market here today. You are looking at Bitcoin off the highs of today, but still up nearly just over 5.5%, have been just above that 90,000 level earlier today, Maddie.
All right, well, U.S. Commerce Secretary Howard Lutnick teasing an update to tariffs on Canada and Mexico, which could come as soon as this afternoon, saying that companies who are compliant with the U.S.-Mexico-Canada agreement could be exempt from a portion of that 25% tariff. Here with more, we've got Ben Worschel. And Ben, I was so excited to talk to you about this because Lutnick gave us kind of a peek into the negotiation handbook this morning, saying if you're USMCA compliant, you might be exempt. Talk to me about what that means and how we can use that knowledge to suss out who else might be exempt.
Right, for sure. Yeah, I mean, the number one sector here that appears to be kind of looking for some relief is autos. This is a reference to what's called automotive rules of origin, which is written into USMCA, basically to acknowledge that a car is a lot of time kind of simultaneously built across multiple countries. It'll go back and forth across the U.S.-Mexico border. And what Lutnick was talking about this morning was potentially allowing the rules of that USMCA to go forward on that. So that would be a big concession for the auto industry, which has been screaming about this, frankly, ever since Trump talked about blanket tariffs on the U.S. and Canada. The larger context point I'd make, too, is that everything Trump is doing right now in terms of Canada and Mexico is an exception. The way the agreement is written is that there's all these kind of works out for different regions, and then you can kind of get around it by going national security, and that's what Trump has done. He's sort of declared a national economic emergency around this fentanyl and illegal migration, and then essentially driven a huge truck through that to create a blanket exception to essentially the entire deal. So they've already sort of accepted in one massive direction, and now they're talking about going back. And I think that's emblematic of Trump kind of hearing things when the economic pain gets too acute. Another example I'd point to for folks as kind of an example is oil. As in the run-up last month to the Canadian tariffs, it became clear that the oil sector would be really damaged, especially the oil sector in the United States, which is very reliant on Canadian oil. So he carved out an exception there, and right now the duties there are 10%. So it's kind of, the message is getting through to a certain extent. We'll see what the parameters of this deal. Trump sounded different about this, frankly, last night in his State of the Union. He talked about being fine with a quote, little disruption. So we'll see what the parameters of this are, but Lutnick and co are clearly trying to create sort of a carve out where the pain for U.S. economy is most acute.
Yeah, but I guess the question is he actually okay with a little bit of pain? And how closely is he watching some of the reaction that has played out in the stock market over the last couple of days? Of course, there's lots to talk about a Trump put and what exactly that is and whether or not he is paying close attention to the stock market's recent moves. Jason Furman, I asked him that just about an hour ago, and he said he actually isn't paying as close attention as he did during his first administration. I'm curious what you think about that.
Yeah, I mean, I think Trump is very, very consistent on this. It's sort of, I guess it's a question of when markets are going to finally believe him. He says he's very fine with this. He believes in tariffs. His line about tariffs being the most beautiful word in the dictionary is kind of, it's fun to say, but I think it's emblematic of what he wants. And he was again clear about it last night. He believes in putting in tariffs for the sake of tariffs. This isn't a negotiation in a lot of ways. This is about doing this. And Lutnick was even clear about this morning. He says April 2nd, they're going to have kind of a massive wave of reciprocal tariffs. So I think Trump is clearly saying he's fine with some pain, and he's shown a willingness to have that. The question is who kind of gets to him and which sectors are most impacted and can maybe kind of find a carve out for themselves. But I think broadly speaking, I would agree with Jason Furman's point that there's a difference here between Trump 1.0 and 2.0, and that he really, really believes in tariffs down to his core, based on everything he says, not just last night, but for years now.
All right, Ben, thanks so much.
Sure thing.
Well, stocks moving to the upside this morning following better than expected ISM services report, along with some relief following commentary from Commerce Secretary Howard Lutnick that came on tariffs. However, volatility very much front and center for investors as the S&P comes off 2 days of back-to-back declines of more than 1%. The index potentially swinging by up to 1.4% in either direction today. That's according to the latest data compiled by Citi. Joining us now to break it all down, we have Drew Madison. He's the Chief Market Strategist at MetLife. We're also joined by Tim Hayes, the Chief Global Investment Strategist at NED Davis Research. It's great to have you here, Ned Davis Research, excuse me. Great to have both of you. As we start to think about some of the conflicting econ data that we have been getting out this morning, obviously the ISM number that we are digesting right now, that coming in better than expected, maybe offering some relief. But Drew, I'm curious how you're making sense of some of those conflicting signals and then squaring that with the confusion out of Washington.
I mean, I don't think the confusion in Washington has affected the real data yet. I think if we look at the ISM that just came out, what we're seeing is that growth is okay and inflation's a little sticky, which is kind of what we had all known was going to be the case. The wild card is kind of the tariff situation and what impact that has. And I think the biggest impact from tariffs is actually not inflation. It could be growth. And if it's growth, it's going to come through the equity channel into the upper end consumer channel. And so the volatility we see in equity markets is actually something we have to watch carefully because it'll impact the way upper income workers choose to spend or save their money. And it'll encourage them potentially to save more money in the expectation that the growth in the economy will slow down.
Yeah, Drew, we've been talking a lot this week about that Moody's study showing that the top 10% of earners are responsible for half of consumer spending in the U.S. But Tim, I want to bring you into the conversation because I'm curious, under that dynamic and backdrop, does the pessimism that's brewing about the economy, does the market have to drop to meet that pessimism? Or is the pessimism about the economy going to correct itself to allow the market to continue to hit new all-time highs this year?
Yeah, I would say the pessimism is really more about all the various scenarios, negative scenarios that have been considered, with all the uncertainties about tariffs and trade and the trade war. And actually, we have an indicator of sentiment that shows the most pessimism since October of 2022 is basically the end of a long bear market. And at that time, very few stocks were above their 200-day moving averages. And that's not the case today. Actually, most stocks are still above their 200-day moving averages globally. And some markets like Europe are very close to new highs. So I think the sentiment is really out of line with the reality of what our indicators are telling us. And actually not even in line with what the market's been doing, even though we've had this sell-off. It's been pretty normal for a correction. And this kind of pessimism is much greater than we usually see in a correction. So I think would be the other way around. I think the sentiment will come back to what the fundamentals are telling us.
So then, Tim, what is your advice then for investors? How should they then be approaching the months to come?
Well, we're remaining overweight equities. And I would say as soon as we get more confirmation that we're back into an uptrend, I'd say this is a pretty good buying opportunity on the weakness. We have a model that puts everything together. You look at the fact that bond yields, that 10-year Treasury has been making new lows for the year. We have an economic timing model or a global recession probability model, which is down around 12%, very low. We have earnings coming through. We also have the beat rate, which has remained pretty good. 75% of stocks are beating earnings. So, you look at all the actual indicators that drive the market and have been responsible for driving the market higher, they're still favorable. And maybe this will start to change if we do see a negative impact from the trade war. Maybe the indicators will start to pick that up. But until that happens, I think it would be premature to get out of the market right now.
Drew, talk to me about how the market is reacting to policy, just in terms of whether or not that Trump put is officially gone, given that we have retraced all the post-election gains. And do you think that Trump is still looking at the market as a check on his policy?
No, I think your last reporter had it right. I think this administration believes in tariffs, believes that there's a role for tariffs to play. And I think that they are viewing the economy from a longer term perspective. So, not what does it do to the economy in the next 6 months, as much as what it will mean for the U.S. economy 5 to 10 years from now. I think they're taking, I think when you think about this administration, what they've tended to focus on, or a lot of what they're focusing on, has to do with the hollowing out of the U.S. manufacturing base, which they see as having been a precursor to a lot of other problems the U.S. is facing. And when you look at kind of tariff theory, tariffs are appropriate when you are trying to offset negative impacts on free trade to various classes and constituencies, like the workers in the Midwest, manufacturers, et cetera. So I think this administration is thinking about it in kind of a longer term prospect rather than a short term prospect, even if their actions are actually more short term in nature.
All right, Drew and Tim, thanks so much for giving us your insight here this morning. As we head to break, we want to check in on Apple. You're looking at Apple shares actually under a bit of pressure, off just about 1.6%. Apple rolling out updated MacBook Air laptops and Mac Studio desktops, seeking to maintain a sales resurgence for the company's computer line. Now, the company's most powerful computer yet will start just under $4,000 and will offer improved performance, ray tracing, and AI development capabilities. They also have a cheaper option that's going to be starting just under $2,000. Again, they're trying to build on some of that momentum that we have seen. That cheaper option is Apple's M4 Max that starts at $1999, and then of course the M3 Ultra powered Studio starting at $39.99. Again, you're taking a look at broader tech under a bit of pressure. You've got Apple off just about 1.7%. We'll be right back. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, taking a look at Tesla sales in Germany falling 76% in February. This in response to CEO Elon Musk weighing in on the country's closely contested federal election. Now, Musk did endorse a fall rate alternative for Germany ahead of the election on February 23rd. Tesla sales decline was a sharp contrast from the overall EV sales that we did see in Germany. They actually rose by 31% in February. But when you're taking a look at today's stock reaction, you're looking at gains of just about 0.3%. Of course, is coming on the heels of the pressure that we have seen on the stock most recently. It is one of those that is bucking the downward trend that we are seeing across some of those Mag 7 names. But again, Maddie, this calls into question just, I guess, two things. One, just whether or not demand for the EV market, what exactly that looks like, and what exactly maybe those more realistic expectations are going to be here in the months, quarters, and years to come. But then two, just how whether or not Elon Musk is hurting the brand at all, and whether or not this backlash that we have started to see hints of, whether or not that picks up and is actually reflected maybe more broadly and at a larger scale here through the sales in the months to come.
I think it's also interesting in the context of what we're seeing going on in Germany with that spending plan leading to German bonds having one of the worst days since the fall of the Berlin Wall. So perhaps an idea of German stocks lifting, whereas we're seeing the broader economy potentially on the upside, which I only bring up because if we are going to start to see Germany exit this time of economic downturn, maybe that unleashes a little more consumer spending. But you also gave the context that this is not about an overall EV backdrop that we're seeing in Germany, where people just aren't buying the cars. They're specifically not buying Teslas. And I think it's important to just note that that is perhaps coming in response to Elon Musk's political beliefs and the commentary he has had over in Germany. Though, to your point, we do have Tesla still up today, perhaps off the back of that standing ovation that he received in Congress over overnight here. All right, well, next up, Novo Nordisk now offering its weight loss drug Wegovy for less than half its usual price. This is through a new direct-to-consumer online pharmacy they're calling NovoCare. That's going to let patients pay $499 in cash per month for the weekly drug. And this is part of a trend that we are seeing. Eli Lilly also offering something similar with Eli Lilly Direct. That's for the drug Zepbound. That's going to cost anywhere between $349 and $699 per month. It also comes in the context of a lot of consumers losing their insurance coverage for these weight loss drugs. One company estimating that about 5 million have lost their coverage over the last year. So perhaps that will lead to more success for these direct-to-consumer brands that are allowing consumers to buy these drugs directly from these companies, especially if they continue to lower the costs.
Yeah, exactly. I think a lot of times when we've talked about this, you talked about wider adoption, you talk about what the intake numbers are going to look like. A lot of that has centered around costs and being able to bring down the cost of these drugs. Obviously, this is a step in the right direction, although it is very important to point out $499 per month is still pretty expensive and obviously outside the budget of many Americans who potentially would want to be a user of this drug. So again, it is much cheaper than what we have seen, but still the prices for weight loss drugs, especially here at the name brands, especially those making the biggest splash, obviously still out of reach of so many Americans. And of course, that brings into question just how much more affordable some of these drug prices need to be and the access to these types of drugs. But again, you are looking at a ripple effect and not only on Novo Nordisk and the reaction we're seeing there with Eli Lilly as well, but also when you take a look at Hims and Hers and that stock moving on this update as well. Let's take a look at the retail sector. Abercrombie & Fitch plunging after the retailer issued disappointing guidance for its current quarter and fiscal 2025. This is retailers brace for a pullback in consumer spending and the impact of tariffs. Yahoo Finance's Brooke DePalma joining us now with the biggest takeaways. And Brooke, we are seeing a big move here in the share price.
Yeah, shares falling as much as 16% this morning after the company reported this slower sales growth expected in fiscal year 2025. Now, the company said specifically that they expect net sales to grow between 3 to 5% this year as consumer spending does in fact weaken, and that was less than what the street was looking for. That's largely leading to this decline in the share price this morning. Now, the company does see operating margins to come in between 14% to 15%, and that is an outlook that includes the estimated impact on tariffs from imports from China, Mexico, and Canada. They've made sure to say that this does not include any incremental tariffs that could go into place this coming year. But the company did say in response to these tariffs, they have no plans to or intentions to take any significant price increases. They said they've been pretty disciplined in their approach to pricing, and they are keeping close to customers to understand just how much they can spend in this environment. But gross margins did improve year over year. That was driven by lower promotions. The company said that they're also looking to see if they can pull back on any promotion days this year, as they really keep in mind that consumers want promotions, but also sometimes they're willing to spend.
Yeah, and Brooke, just a huge fall off on the stock when it comes to what we're seeing in the market reaction off of that weak forward guidance. What are you attributing that to, especially given that we've seen some weaker guidance from other retailers, obviously Walmart and Target coming to mind? Is this sort of becoming a trend that the retailers have to deal with?
Absolutely. We've heard this from Walmart. We've heard this from Target. We've seen this cautious approach that these retailers are taking. Walmart CFO John David Rady telling Yahoo Finance that he calls it a prudent approach because they really don't know how consumers are going to swallow this potential increase in costs. The tariffs could impact like tomatoes and avocados and agriculture products in the next coming days, and then eventually trickling all the way down to the apparel sector. And so it's really uncertain on how exactly consumers will respond. And so consumers taking this really cautious approach when it comes to same-store sales growth outlooks here.
All right, Brooke, thank you so much for joining us and breaking that down. We appreciate it. As we head to break, I want to take a look at shares of BlackRock. The world's largest asset manager led one of the biggest acquisitions of the year in a deal that marked both the firm's expanded reach and infrastructure and a win for U.S. President Donald Trump, who had raised concerns over control of key ports near the Panama Canal. The company led a consortium that will buy a controlling stake in Panama ports that had become a political lightning rod in a larger unit that has operations across 23 countries. CK Hutchinson is saying it would receive cash proceeds of more than $19 billion from the sale. You can see BlackRock shares up just about 0.6%. We'll be right back.
President Trump's drill baby drill policy getting a standing ovation at last night's address to Congress. The president saying that he is focused on reducing energy costs as a way to tamper down inflation, very much reiterating some of the rhetoric that he has been saying as of late. Now, his tariff announcements in tandem with an expected boost in supply from OPEC have also weighed on oil prices over the past several sessions. We now have crude below $70 a barrel. Joining us now with more, we want to bring in Fernando Valle. He's Hedgeye Risk Management's energy analyst. Fernando, it's great to have you back here with us. Let's talk about maybe what is the biggest driver in your view of the drop that we've seen in crude prices and really across the board when it comes to oil over the last several days. Is it more tariff driven or is it more OPEC driven?
I think without a question, it has to be OPEC plus increase in supply. I think that was something that most analysts expected to be delayed continuously throughout 2025. We're still not in a super tight oil market. So bringing in as much as 2.2 million barrels a day, which is just over 2% of global supply, back into a market that's not, again, very tight, is almost certain to bring prices down.
So it sounds like you think that OPEC plus output hike outweighs any potential negative impact from tariffs that could lead to a lift in prices.
Yeah, absolutely. And especially because when you hear what's happened since even when we spoke yesterday at night, they're already talking about not pushing those sanctions on Canada or Mexico. And even the energy tariffs themselves are only going to be 10%, not 25%. I think the consumer has been very clear that they can't afford higher prices. And so even if any tariffs came on, I would expect that to be borne more by the refiners and by the oil producers than by the consumer itself, because again, they're already fairly stretched.
And Fernando, you have crude obviously below $78 a barrel. You also had Brent breaking below $70 a barrel this week. I guess the question is, given all of this, what does that downward pressure then potentially look like? How big of a slide could we be potentially seeing?
Well, I know from our sources in the administration that they want oil to go as far down as $50, whether that be Brent or WTI, to help with inflation significantly. And of course, energy is a major component of inflation because it affects nearly every other segment. So it could be pretty painful if they try to get more production out. And again, OPEC Plus has an outsized weight on global supply, even more so than shale could do. I think Scott Bessent, the Treasury Secretary, has talked about trying to raise U.S. production by 3 million barrels of oil or 3 million barrels of oil equivalent. I think that's not feasible, but OPEC can do it and in relatively short order. So that's, again, not a super tight market. Adding that supply, you could push it down quickly. It is counterbalanced by Germany saying yesterday as well that they're going to increase investment significantly. So that could be higher energy demand. But we'll have to see which one prevails at the end.
Fernando, prices go that low. How much pain is that for some of these larger oil giants?
For the larger, not so bad because they have really strong balance sheets. You know, you look at an Exxon, a Chevron, even a Diamondback, they have pretty strong balance sheets, and they've braced themselves on not having oil price support in the near term. They can withstand this shock. It's really the players that rely more on capital markets, the players that have weaker balance sheets. You know, I'm looking at a Devon Energy, or players that are in more marginal basins like a Chord Energy that is in the Williston Basin, is a pure play on the Bakken. They might have to shut first because their cost structure is just higher than someone in the Midland Basin or in the Permian, like a Diamondback, for example.
And Fernando, since you're already talking individual names, what would you say is the single best investment idea that you have in terms of a company that could be the biggest beneficiary of these lower energy prices?
Well, we tend to like the natural gas names. We have Range Resources as one of our best ideas because on top of getting more demand for natural gas overall from reindustrialization, AI, data centers, you're also getting more demand for LNG that's going to Germany, as I mentioned, and other parts of Europe. And then on top of this, the tariffs and lower oil price will decrease the production of associated gas in the U.S. So that would lower the overall supply of natural gas, which would be positive for someone like Range that does dry gas, doesn't produce oil, mostly natural gas.
And since you mentioned your sources within the administration, Fernando, I'm just curious what you've heard from folks in the White House in terms of potential carve-outs for energy suppliers, not just from Mexico and Canada, but even as the administration teases out further tariffs to come from other countries as well.
Well, our main importers are Canada and Mexico. So I think that considering that OPEC Plus probably was influenced by the Trump administration, we don't import significant volumes from OPEC anymore. But I would expect that also would not be taxed at the same level as other tariffs.
All right, Fernando, we got to leave it there. Thank you so much for joining us. We appreciate it. We're going to get a check-in now on some chip stocks, something the president touted on last night's joint address to Congress, talking about the end to Biden's CHIPS Act. Again, that multi-billion-dollar CHIPS Act from the Biden administration, Trump calling an end to that, while also announcing investments into chips manufacturers that would bring domestic production to the United States. So an interesting kind of cognitive dissonance on those two policy positions here. But you can see a lift to some of these chips names, specifically Broadcom lifting ahead of earnings up about 1.8%. You have some pressure in those domestic names like AMD and Intel, and then you've also got Nvidia flipping around the flat line a little bit today, again, off of that announcement from President Trump calling an end to Biden's CHIPS Act. We're going to be back with more markets coverage here on Catalysts. The tech trade continuing to come under pressure as of late as the Nasdaq falls nearly 10% from its peak. So could software stocks present an opportunity amid this sell-off? Joining us now with more, Jackson Ader, KeyBank Capital Markets Managing Director and Equity Research Analyst. Jackson, thanks for being here. So we've been talking about the impact of these tariffs all morning, and one of the questions we have is around CapEx, as we're seeing companies sort of pausing on spending, having some questions about the policy implications moving forward. How could some of these AI companies be impacted if we do see a slowdown in CapEx?
Well, if we see a slowdown in CapEx from the broader industry, I don't really see much of an impact in terms of its negativity or potential for the software stocks. But if these tariffs or just the broader uncertainty maybe calls into question whether the software companies or the hyperscalers that are spending a ton of money on CapEx, whether it calls into question whether those investments are a good idea or not, that is where the CapEx cycle would impact software. But in terms of their customers, I'm not really sure if I see much of a direct impact at this point.
Do you see any correlation just to the threats of tariffs and the real risk there, and maybe the implications more broadly speaking across the industry?
So the tariffs, we all know this, whether in software, it's not as if those companies are importing many things from Mexico, Canada, China, wherever. It's not. They are human businesses. They are intellectual property businesses.
Yeah. But just going back to Maddie's point, and more so introducing the uncertainty, right, and the impact that's going to then potentially have on CapEx, and I guess those that could be most exposed.
Yeah. So what ends up happening is that uncertainty it elongates deal cycles. And if there was a deal that maybe you have hopes that it might be $200, maybe that deal ends up being $180, right? There might be a marginal decrease in the total deal size for some of these larger software deals just because of the uncertainty. Even if it's not directly related to the tariffs, it's just broader macro uncertainty that ends up hitting software companies. So I would think to myself, okay, what are some of those? Some of the larger, the large cap that end up signing large platform type deals that could come under pressure for a reduction in size or an elongation of the time that it takes for those customers to make their decision.
So let's look at an example of a company you cover like Microsoft. One of the questions I have is, as we've started to see all of this tech volatility, the sell-off in the Mag 7, has anything fundamental to these companies changed that would impact anyone's bull case on a stock like Microsoft? Have you seen any material change to the business that investors should be worried about?
I don't think so. No, fundamentally no. Other than, like I mentioned, the risk that some of their larger deals might either decrease in size or some of their larger deals might take a little longer to close. But because of these tariffs, are people going to stop the broad secular trend of moving on-premise workloads over to public cloud and Azure? Are companies going to stop their investments in artificial intelligence? Are they going to reduce their workforces and come under pressure for maybe a Microsoft Teams? I just don't think so. I really don't think so.
Jackson, let's talk about, I guess, for investors that are trying to figure out the best plays within the space, just given some of the trends that you're watching, given the latest earnings and what we've seen, even some of the plans here for future spending. Who's at the top of that list?
So we're here, one of the reasons that I'm on is for, we're hosting the KeyBank's Emerging Technology Summit, and it focuses on large private companies and then mostly small and mid-cap public software companies and public tech companies. So I'm thinking to myself, okay, there might be an opportunity here with a bunch of choppiness and a bunch of volatility, specifically in small and mid-cap, where you can still find, even though they're small, even though they're mid-cap, you can still find really high quality assets that are in that 5, 10, 20, $30 billion market cap range. Ones that I would mention would be HubSpot. We also like Monday.com. And then on the smaller end, a couple of companies that we like in small cap are SEMrush and Amplitude. Those would be 4 that I would mention that are high quality, heading in the right direction in terms of their growth, and the choppiness creates a really nice opportunity.
Jackson, thanks. Keep it right here on
Thank you.
Yahoo Finance. We got much more of your market action ahead. You're watching Catalysts.
The SIBO Volatility Index touching its highest level year to date this week as traders face market instability following President Trump's tariff agenda. So how is the volatility playing out in the ETF market? I want to bring in Noel Archer joining us in studio for this week's ETF report brought to you by Invesco QQQ. Noel, thanks for joining us in person today. We appreciate it. So just curious what you're seeing in terms of the increased volatility this week and what that tells you about what ETF flows might start to look like moving forward as the market digests all the policy uncertainty.
Yeah, I think, I think overall we're seeing still strength in the flows. We've seen it was a record-breaking year for ETF flows last year, and if you look at the first 2 months of this year, it seems to be tracking to an even higher level. So I think that's reflective of the fact that there are just so many flavors of ETFs out there today and so many different types of investors. A lot of different views are being expressed, which is not surprising given some of the activities that have happened over the last few months. It's very hard for anyone to be right or wrong right now because it seems to be shifting on a day-to-day basis. We've seen a reversal in the flows to some degree, where we saw a lot of participation, obviously, in sort of the strong equity markets at the end of the year and a little bit of softness in the fixed income markets. That's flip-flopped over the last 2 months, stronger fixed income markets versus equities. But we're still seeing a lot of flows into U.S. large cap securities. So I think just reflective of still this bet that in the long run, the U.S. economy still has some legs to it. We're seeing some softness in small caps, so a little bit of that maybe taking a little bit more of a conservative approach. And things like dividend securities, others are starting to get a little bit more play.
What about the international component? Are you seeing more interest, I would guess?
Yeah, absolutely. I mean, if it's actually been a pretty, again, surprising few months, maybe not surprising, but very different. If you look at EFA versus S&P returns over the 1, 3, 5, 10-year periods, EFA has delivered about half. Sometimes less than half of what the S&P 500 has produced. So there's been a pretty big bias there. EFA is up very strongly at the start of the year. You're seeing obviously some engagement in possible increase in defense spending in Europe, other triggers that are causing reinvestment to happen in Europe. So outside investments are making up about 15% of ETF flows, which is a step up from what we've seen over the last couple of years.
But it sounds like that's not leading to as much of an outflow from large cap names as I might have anticipated.
Yeah, I think part of it is that the pie is getting bigger, so just a chunk of that allocation is going to international, where we're seeing a little bit of reallocation flows, a little bit less in the long end of the curve on fixed income products, as again, there's maybe a bit of defensiveness, where heading into the year, as we ended last year, heading into this year, the thought was maybe that rates would stay stable for possibly a bit longer, while there might be rate declines coming in the year ahead, possibly. maybe not as many. As you're looking at some signs of economic weakness, some questions around what the tariffs might do in the short run versus the long run, and is it a policy change or is it just a negotiating tactic? There's been a little bit of that pullback, that thinking that maybe there could be a few more rate decreases. And if that's the case, then do people want to change the duration of their portfolio? So we're seeing a bit more play in the short end of the curve from ETF flows. We're seeing money go into ultra short products. We're seeing it go into other sort of short duration where you could eke up a little bit more yield, but not have as much rate risk. And again, it's an important factor because there's still a lot of cash on the sidelines. I mean, that's another very persistent trend that we're seeing. There's $7 trillion sitting in money market funds still.
Has that surprised you a little bit?
It does a bit. I mean, the unsurprising part is, well, it's really nice to get 4.5%, 5% out of your cash, basically, right? We haven't seen that in more than a decade. But on the flip side, folks that did that missed, over 20% return in equities in 23, over 20% return in 24, and some really higher yields in different parts of the credit space. So it might have been a feel-good play, but it actually eroded some of the nice returns that could have been achieved had you been a little bit more invested in a traditional allocation space.
And what do you think is going to potentially push that money out of the sidelines? I know that's the big question, but what might that look like?
Yeah, I mean, I think if we do start to see that rate decline, they tend to sink a bit faster in money market yields. Obviously, that will be a push into that ultra short space, or possibly other parts of the equity market, even potentially high yield if spreads widen there a bit. I do think if we see money market rates fall below that 4%, 3.5% threshold, that might be enough of a trigger to go there. Or if we see sort of clarity around policy and signs of sort of a clearer path towards ongoing economic growth, that might also keep people from being a bit more conservative to reinvesting back in the market. Which again, if you're looking at a long term, if you're going to be in the market, 5, 10, 20 plus years, this is a lot of noise versus giving up potential returns.
No, what have your conversations with clients been like here over the last several months? Obviously, digesting a new administration, obviously, when you take into account the number of changes potentially here to policy. I'm curious just how you're guiding them just during this very uncertain time.
I think where most of the questions that we get from them, and certainly our dialogue, is around what I was just talking about, sort of what's the long-term plan. For most clients of ours, where we're working with wealth managers, wealth advisors, financial planners, their view is very much long-term. Where are they trying to get a client to? And even for clients thinking about their own portfolios. So if you have a long-term time horizon, again, focus on that. What are those longer-term goals? Where we talk about the short term with them, it's in those spaces of, okay, is there a way that you can increase yield, come out of cash, go into ultra short fixed income products? There's a lot of products now that look at either defined outcomes within the ETF arena, buffered products that try and limit some of that downside. Again, if you're a year or two away from retirement, that's not when you want to go into the 10, 15% divot to move back out of. So having the buffered products can be very helpful. There's more of those to look at. If you're moving into a phase of life where income might be more important, great time from some of the higher yielding, longer dated credit products, but also some really nice products in the equity income that have evolved in the ETF space, and frankly in other vehicles as well over time. So we really, you think about that bracket, almost that barbell. What are those immediate needs, and how do we make sure that we limit volatility while still either keeping an income or some growth component, and then focus longer term around what are those, where can you take a bit more risk for equity growth? Where can you take a bit more risk to increase income yield?
Makes a lot of sense given where things stand. Noel, great to have you. Thanks so much.
Thank you very much.
The Fed's latest Beige Book report is out today at 2 p.m. Eastern Time. Joining us now with a breakdown about what the Beige Book covers and how officials use that data to make rate decisions is our very own Jennifer Schomburger. Jennifer.
Seana, the Beige Book is a compilation of anecdotal evidence from the ground across the Federal Reserve's 12 bank regional districts about the U.S. economy. The regional Fed banks talk to businesses, large and small, banks and manufacturers, to understand how the economy, employment, and inflation are faring. It's a way to judge how the economy is doing in real life as opposed to just looking at statistics collected in data reports. The Beige Book covers everything from inflation trends, whether companies are able to pass on any rising costs to consumers and raise prices, to the health of the job market, including hiring patterns and whether companies are raising wages. It also touches on consumer spending trends, the health of bank lending, home sales, and the state of manufacturing. The survey won't name names of companies, but officials survey, for example, big box retail stores like Walmart, all the way down to the local merchant. Fed policymakers then use those findings to see if the official data line up with what they're hearing on the ground. All of this information is used to make decisions about setting interest rates, which impact what we pay as consumers and businesses when it comes to borrowing rates. Back to you.
All right, Jennifer, thanks so much for joining us to break that down. We do appreciate it. Let's get a check on the markets 90 minutes into the start of trading here. You are looking at stocks returning to the upside here, but just barely, right? You've got your S&P up about 0.1%, the NASDAQ up 0.2%, and the Dow recovering again just a bit off the back of the biggest two-day loss that we'd seen in the market since last December, that coming on the heels of those tariff announcements, 25% on Canada and Mexico, and that additional 10% tariff on China. Though Commerce Secretary Howard Lutnick teasing out the idea this morning that we could get clarity on any carve-outs, any exemptions from those tariffs, specifically leading to a lift in a lot of those auto stocks this morning. You had the likes of GM, Ford, and Stellantis moving to the upside significantly off the back of those tariff comments.
All right, well, we're just getting started here. Yahoo Finance coming up next. It's Wealth. Maddie has you for the next hour. I'll see you tomorrow.